here because you want to cut through the noise, figure out what's really driving the economic headlines.
Yeah, you want to stay informed, but without needing, a PhD in economics.
Exactly. And that's what we're doing here. We've dug into a bunch of recent financial reports to pull out the key stuff you need to know.
Right. Our mission, if you like, in this deep dive is really to connect the dots for you. We're looking at the latest on inflation, trade talks, that ever-present budget deficit, and interest rates, how it all fits together.
We've got a mix of sources aiming for a pretty clear, concise overview of where things stand economically right now.
Okay, so inflation first. It really does seem to touch everything.
Definitely. From, your grocery bill to those potential Fed rate cuts everyone keeps talking about.
So the latest numbers, these are for April. Year-over-year inflation came in at 2.3%.
And core inflation.
Core was 2.78%.
Yeah.
And honestly, that was a bit better than many economists were predicting.
Yeah, especially with all those worries about tariffs potentially pushing prices up.
Exactly. It seems like those concerns, well, they haven't fully hit the inflation numbers, at least not yet.
And these figures are getting closer to the Fed's target, right? Which
Yeah.
is 2%.
That's the goal. And core inflation, just to remind everyone, strips out food and energy prices because they jump around so much. It gives a clearer view of the underlying trend.
So with inflation maybe trending down, does that mean rate cuts are coming soon?
Well, it certainly raises the question. The odds of an immediate cut haven't really shifted much, but September? That's starting to look like a potential window if inflation keeps heading down. It's a big if.
Okay, but here's something odd. We have this relatively good news on inflation, maybe some positive signs on trade talks too, which we'll get to. Yet the 30-year Treasury bond yield, it's climbed to an 18-year high. That seems counterintuitive.
It does, doesn't it? Good news here, but this key long-term indicator is flashing. Something else. A higher yield usually means investors want more return for the risk.
So why now? What's the thinking?
Well, some of the analysis we looked at suggests it might be about a lack of confidence in the long-term fiscal situation. Worries about government debt down the road.
Overriding the short-term good news.
Potentially, yeah. Investors holding those long-term bonds might just be demanding a higher premium for what they see as future risks.
Okay, let's shift gears then. Trade. U.S. and China. We're hearing about substantial progress.
Right, and specifically these 90-day tariff reductions. The U.S. is said to be cutting rates on Chinese goods quite significantly, from 145% down to 30%.
Wow, that's a big drop. And China?
China's reducing tariffs on U.S. goods, too, from 125% down to 10%. So, on the surface, yeah, big moves.
But what's the catch? Or the context?
Well, the context is important. While it's definitely positive news, and maybe better than some expected, it kind of just rolls back tariffs to where they were before the most recent hikes.
Ah, okay. So less of a breakthrough, more of a return to a previous status quo.
Sort of. One report framed it as maybe a tactical pause, setting the stage for more talks, rather than a fundamental change in trade policy itself. The immediate economic impact might be a bit limited.
Still, the markets liked it, didn't they? Equity futures went up.
They did. Markets often react to the headline news, the direction of travel. And this news also seemed to lower the perceived odds of a recession. They dropped from about 65% down to 40%.
But that creates its own issues, right? This kind of back and forth based on news headlines.
Absolutely. Some sources called it a nervous and anxious market because it's so sensitive to this stuff, especially trade news. Volatility is high.
And the timing of future talks, is that linked to the Fed at all?
That's an interesting point. The thinking is that to keep the Fed looking independent, the next major round of trade negotiations will probably wait until after the June FOMC meeting.
Right, makes sense. Avoid any appearance of coordination.
Exactly.
Okay, so let's talk about the elephant that's always in the room, the U.S. budget deficit.
Yeah.
And the debt.
Yep. Still there, still a major concern, highlighted in, well, pretty much all our sources, even with other positive signs.
And President Trump's tax plan is part of this conversation, right? The One Big Beautiful Bill, or OBBB.
That's the one. There seems to be a push to get it through Congress before Memorial Day.
Why the rush?
It looks like it might be linked to trying to address a potential debt ceiling fight looming in July, sort of getting ahead of that crisis.
But will the plan actually reduce the deficit? There seems to be doubt about that.
A lot of skepticism, actually. The concern is, unless this plan somehow sparks a huge surge in manufacturing and tax revenues, or unless there are big spending cuts somewhere else.
Which don't seem likely right now.
Right. The worry is the deficit could actually get worse, not better.
And this loops back to the bond market signal we were talking about earlier.
It connects directly. Think about the CDS market credit default swaps. That's basically where investors bet on the risk of someone defaulting on their debt.
Okay.
Right now, that market is pricing both China and, get this, Greece as less risky than the U.S.
Wow. Less risky than Greece. How does that make sense?
Well, some analysts argue it reflects deep concerns about the long-term sustainability of U.S. debt, especially given future spending projections. That perception of higher future risk compared to, say, China or Greece in the CDS market could be a big part of why that 30-year Treasury yield is climbing towards that critical 5% level.
So the market might be pricing in these fiscal worries, even while it reacts positively to short-term trade news. That's quite a split.
It's exactly that tension, a real mix of signals. You've got encouraging inflation numbers, some progress on trade, but at the same time, rising long-term yields and these deep worries about government finances.
It just shows how sensitive everything is right now to trade news, economic data.
Absolutely.
Yeah.
And that potential rate cut in September, we have to keep saying it, it really hinges on the data we get between now and then, especially that Q2 GDP number. That'll be huge.
So wrapping it all up, it's complicated.
Definitely complex. Progress on trade offers, a bit of optimism. But these underlying concerns about the deficit and how that impacts interest rates down the line, they aren't going away. It makes for a very tricky economic landscape.
And yeah, the S&P 500 might be green for the year again, but that rising 30-year yield, the CDS signals, those are definitely things to watch closely.
So here's something for you, the listener, to think about. We see these quick, positive market jumps on trade news, but then there are these persistent long-term worries about the national debt. Which factor do you think is more critical to watch over the next few months for the real health of the U.S. economy?